Welcome to the deep dive where we cut through the noise and get straight to the insights you need. Today we're plunging into Navitas Semiconductor, ticker NVTS. This is a company standing right at the crossroads of the AI and EV revolution. It's a fascinating story. You've got cutting-edge tech, bold strategic shifts, and some seriously high stakes. Currently trading around $5.61, and what's interesting is that our deep dive has actually uncovered an estimated intrinsic value range that, well, it wraps pretty neatly around that current market price. This suggests, a rational valuation, but one that's incredibly high risk, high reward. Really, it's a bet on whether a brand new management team can navigate this minefield of challenges, technical, financial, geopolitical, to unlock what could be truly massive potential.
Yeah, what's really compelling about Navitas is how perfectly it illustrates that tension, between the promise of groundbreaking tech and the, frankly, harsh realities of execution and market forces. You're going to see a company with tech that could genuinely change things, but it's also facing threats that are, well, existential. So for you, the learner, this raises a really crucial question. How much risk are you willing to embrace for a piece of tomorrow's future?
Absolutely. So to really understand Navitas, we've organized our deep dive into two main parts. First, we'll lay the groundwork, then we'll broaden the view to the market and risks. In part one, the foundation will cover chapter one, business analysis, then chapter two, management evaluation, and finally chapter three, financial analysis. After that, in part two, the broader picture, we'll explore chapter four, market sentiment, followed by chapter five, ownership structure, chapter six, risk assessment, and we'll wrap it all up in chapter seven, conclusion. Ready?
Let's do it.
Okay, let's jump right into chapter one, business analysis. This company is what you call a pure play pioneer. They're focused exclusively on these next-gen power materials, like gallium nitride, that's GaN, and silicon carbide, SiC, forget old silicon. This is about smaller, faster, much more efficient power electronics. It's the future, really.
And how they operate is key here. Navitas uses a fabless semiconductor business model, so they market their chips, but the expensive part, the manufacturing, they outsource that to partners like TSMC and now PSMC. This keeps them agile, lets them focus capital on innovation, not on building fabs.
Right, so what are they actually selling? Their flagship stuff is GaNFast power ICs. These aren't just simple components. They integrate everything, the power transistor, the drive, control, sensing, protection, all onto one single chip. It's like a digital in, power out building block. Think phone chargers 3 times faster and half the size, that kind of thing.
Exactly. And to round out their offering, they picked up Genesika Power Devices back in 2022. These focus on high-voltage silicon carbide for applications needing more than 3 kilowatts. That's crucial for things like EV powertrains, big industrial systems, renewable energy setups. So what they offer is a really comprehensive next-gen power solution, but without any of that legacy silicon baggage.
And they've made a mark, haven't they? Shipped over 100 million GaNFast devices by 2023, mostly dominating mobile fast charging. But here's where it gets really interesting now, their pivot. They're using that success to push into these massive new markets, AI, data centers, EVs, solar power. It's all part of their mission to electrify our world.
And the market trends, they totally back this up. The GaN market alone is projected to grow over 20% CAGR compound annual growth rate. That could mean $12 billion to $20 billion by the early 2030s. And silicon carbide is booming too, expected to jump from around $3 billion now to over $10 billion by 2035, mainly thanks to EVs and renewables. These aren't just short-term things. These are powerful multi-decade megatrends.
Sounds like a potential gold mine, but it's a tough neighborhood, right? They're up against giants Infineon, Texas Instruments, plus specialized players like Wolfspeed.
Definitely. But the barriers to entry here are pretty substantial. Navitas has over 250 patents protecting their IP. Plus, you need really complex technical know-how for integrated chip design and significant ongoing R&D money. It's not easy to just jump in.
So what's their edge?
Well, their competitive advantage is pretty unique. They've built a strong GaNFast brand. They also offer system-level cost savings for customers because their integrated chips reduce the total number of parts needed. But maybe their biggest asset is that deep IP portfolio and their engineering team's knack for integrating GaN functions monolithically all on one chip. That means better performance, better reliability.
And being pure play in both GaN and circuitisha means they can always suggest the best tech for the job, not just the one they have. But like you said, that focus is a double-edged sword. No old cash cow silicon business means they're really all in on GaN and circ succeeding.
That's a critical point.
Yeah.
And it raises an important question for you, the learner. How are they handling that risk? Well, we've seen this crucial pivot. They built their name on mobile chargers, yeah, but their future now is explicitly tied to higher power, higher margin stuff, AI data centers, EVs. That recent revenue dip, it wasn't just market conditions, it was partly a deliberate choice, this more selective mobile strategy. They're trading some short-term revenue for potentially more valuable long-term wins. It's a fundamental shift in their business model. You have to understand that to understand where they're headed.
Okay, that makes sense.
Yeah.
Let's transition now to Chapter 2, Management Evaluation. The story here is really one of transition, isn't it?
Absolutely.
The founding team, led by former CEO Gene Sheridan, you had to give them credit. They built a visionary startup, took it public via a SPAC, and made that key GeneSiC acquisition. Their track record suggests they created something like $4 billion in new business over their careers. Pretty impressive.
Very. However, 2025 brought this sort of perfect storm of challenges. Semiconductor downturns, tariffs, slowdowns in EV and solar. It triggered a crisis response. The board formed an executive steering committee focused squarely on cutting costs and finding an accelerated path to profitability.
And the big outcome of that was appointing Chris Alexandra as the new president and CEO, effective September 1st, 2025. This isn't just swapping faces. It's a very deliberate strategic reset. Alexander is a seasoned hand, over 25 years in the game. He managed a $2.5 billion power division at Renesas. And crucially, while he was there, he successfully pivoted their power strategy towards cloud, auto, industrial, exactly where Navitas wants to go. He even oversaw buying a direct GaN competitor, Transform, so he knows this space inside out.
Yeah, his resume fits Navitas' current needs almost perfectly. It clearly signals a shift, moving away from that tech-focused startup vibe towards a more commercially driven, profit-focused enterprise. This leadership change is probably one of the single most important factors for Navitas right now.
And transparency. How are they doing there?
Well, they have an active investor relations program. Regular press releases, earnings call transcripts are available. They also make a big deal about their commitment to ESG, environmental, social governance. They were actually the first semiconductor company certified as carbon neutral.
Okay, but there's a but here, isn't
There is. It gets a bit, well, complicated. Is that public ESG story fully aligned with third-party ratings? Sustainalytics, a very reputable firm, gives Navitas a high ESG risk rating. That puts them near the bottom of their peers, like 332nd out of 374. That's not great. It suggests maybe there are underlying issues, perhaps in governance or supply chain stuff, that aren't fully captured in the public narrative. It makes you wonder about priorities. You know, is it optics over substance?
Interesting point. What about how they use their money? Capital allocation.
It's all about growth. Heavy investment in R&D, obviously, and strategic M&A, like buying GeneSiC for SiCTech, and buying out their JV partner in Halo Microelectronics for silicon control ICs.
And didn't they just raise cash?
Critically, yes. In Q2 2025, they raised about $100 million net selling shares. That money is specifically tagged for investing in AI data centers and energy infrastructure. This capital raise is, frankly, a crucial lifeline. Why? Because they're burning cash, as we'll see. This buys them time to execute this big pivot, especially since significant AI revenue probably won't hit until late 2026, maybe 2027.
Okay. And dividends, buybacks.
None, which is totally appropriate for a high-growth, pre-profit company like this. All focuses on reinvesting.
Makes sense. What about return on invested capital?
Ah, ROIC. This metric tells you how well they're using their money to generate profit, and for Navitas, it's deeply negative. We're talking a negative 17% to 38% on a trailing 12-month basis. That's way below their estimated cost of capital, their WACC, which is around 22%. So plain English, they're currently destroying value as they grow. This just underscores the immense pressure on the new management. They have to turn this around and start generating positive returns.
Okay, let's put some numbers on this. Time for Chapter 3, Financial Analysis. As of today, September 9th, 2025, market cap is $1.20 billion. Trailing 12-month revenue is $68.17 million.
Right. And that financial profile, it's textbook tech hypergrowth investment phase. Gross margin is okay, 27.09 per CTM. But operating and net margins, deeply negative. Negative around 59% and negative around 82% TTM, respectively. That just reflects this massive R&D and SG&A spends we talked about. Investing heavily for the future, but it hurts the bottom line now.
So bottom line is, not profitable, burning cash. Free cash flow was negative $65.6 million in 2024 and negative $11.9 million in the last quarter. That's significant cash burn.
It is. However, and this is a big however, Their financial stability is actually quite remarkable. Their debt-to-equity ratio is incredibly low, 0.02. They're basically debt-free. And their current ratio, a very healthy 8.23. That means they have a ton of liquid assets compared to short-term debts. This fortress balance sheet, it's probably their most critical financial advantage right now. It gives them that runway, that breathing room to execute the pivot without worrying about immediate bankruptcy or anything like that.
Okay, so valuing a company like this, tricky, right? Negative earnings mean PE is useless.
Totally useless. Their price-to-sales ratio is about 17.6. That's very high. It tells you the market is pricing in a lot of future growth already.
So what's a better way?
A discounted cash flow model, or DCF, is more appropriate here. Our educational model tries to balance things. We put in aggressive growth assumptions starting maybe 20%, ramping up to 40, 50% later for AI and EV wins. But we also use a very high discount rate, 15% to 20%, because of all the risks. And that model gives us an estimated intrinsic value range of $4.50 to $7.50 per share.
And that high discount rate is key, isn't it? It accounts for all those risks we've mentioned.
Exactly. Current unprofitability, the super high stock volatility, its beta, is about 3.0, 3 times more volatile than the S&P 500. Plus, technological execution risk and, as we'll get into more, that extreme geopolitical exposure. It all gets factored into that higher discount rate.
All right, so we've unpacked the business, the management shift, the financials. Let's now transition into part 2, the broader picture, and look at the market and risks. Okay, kicking off part 2 with chapter 4. Market sentiment. And Wall Street's view on Navitas, well, it seems decidedly mixed. It really reflects that classic tension, doesn't it? Long-term potential versus these very real near-term challenges.
Yeah, absolutely. The analyst consensus rating is generally hold or maybe buy from about 8 or 9 firms. But look at the price targets. They're all over the place. From a low of $1.50 to a high of $8, that's a huge range, the average. It falls somewhere between $5.65 and $6.74, which, interestingly, is very close to the current share price. It screams wait and see, right? Analysts seem to want proof of execution before they get really bullish or bearish.
And recent news totally backs that up. You see the bulls getting excited about the NVIDIA partnership for AI data centers, design wins with Xiaomi. But then the bears jump on the disappointing Q2 2025 earnings, the weak guidance. And if you look at retail investors, say on Reddit, they're split too. Some see it as a no-brainer tech play. Others call it overvalued hype because of that China dependence.
And speaking of skepticism, what's really fascinating, maybe even alarming, is the short interest. It's exceptionally high. 42.24 million shares sold short. That represents 22.84% of the company's float the shares actually available for trading. Anything over 20% is considered very high. It signals significant bearish sentiment. And it might not just be a bet against profitability. It could be a bet that there's a specific major negative catalyst coming, like those potential tariffs we'll talk about. It suggests some people see a very specific vulnerability.
Okay, what about the technicals? The chart.
Well, the stock is currently trading below its 50-day moving average, $6.75, which is usually seen as a bearish short-term signal. But importantly, it's still holding above its 200-day moving average, $4.16, which suggests the longer-term trend might still be bullish.
So the chart mirrors the whole story then.
Perfectly. Short-term headwinds and doubt versus long-term optimism fueled by AI and EV growth. It's a real tug-of-war in the market.
Let's move on to who owns the stock. Chapter 5, ownership structure. Institutions own a pretty significant chunk, right?
Yeah, somewhere between 32% and 46.1% of the shares are held by institutions. Big index funds like Vanguard, BlackRock, they're in there.
But what have they been doing lately?
That's where it gets a bit murky. Recent filings show a mixed pattern. Some big funds have actually been reducing their stakes or even selling out completely. So for you, the learner, that raises a question about their conviction level. Are they just taking profits, or are they seeing risks that make them nervous?
Okay, what about insiders? Management, founders?
Insider ownership is notably high, almost 30%. Ranbir Singh, the founder of Genesis, holds a big piece.
But, and this seems like a big but.
It is. Here's where it gets really interesting, maybe concerning. There has been heavy, consistent insider selling over the past year. Get this, 47 sales transactions in the last 6 months alone, and 0 open market purchases by insiders during that time. 0.
Wow, that doesn't sound great.
It's a significant red flag. You have management talking up the future publicly, but their personal financial actions seem to tell a different story. Now look, some selling is normal diversification, taxes, whatever, but the sheer volume here and the fact that it's entirely one-sided, It does suggest a potential lack of conviction in the near-term prospects at the current price. Or maybe they just feel their stock compensation is extremely generous.
And the rest of the shares. Retail investors.
Yeah, a fairly large chunk, about 45%, is held by retail investors, and having such high retail ownership can definitely contribute to that high volatility we mentioned. Retail investors are often more influenced by sentiment and headlines than deep fundamentals.
Okay, let's tie the risk together. Chapter 6. Risk assessment. We'll use a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Sounds good. Starting with strengths. Clear technology leadership in GaN and SILI. A strong IP moat, over 250 patents. That fortress balance sheet we talked about. High cash, almost no debt. And really important validation from big-name customers and partners. NVIDIA, Xiaomi, Samsung, Volvo. That's huge credibility.
Okay, now the weaknesses.
Persistent unprofitability, obviously. Significant cash burn. Extreme revenue concentration, this is a big one. 60% to 70% of their revenue comes just from China. And a critical supply chain risk. TSMC is getting out of GaN production by 2027. That forces a really complex, potentially expensive transition over to PSMC. Lots of execution risk there.
All right, let's look at the upside, opportunities.
The potential is genuinely enormous. AI data centers alone, that could be a $2.6 billion market by 2030 for their kind of tech.
Yeah.
The global shift to 800-volt EV platforms is a massive driver for both CC and GaN, and the huge push for renewable energy solar inverters, energy storage, offers vast potential too.
Okay, balanced view now, the threats.
Intense competition, we mentioned that. Giants and specialists breathing down their neck. The semiconductor industry itself is notoriously cyclical, boom and bust. And there's always a risk of technological obsolescence. What if a better material or design comes along?
Plus the macro environment.
Right. High interest rates make capital more expensive, inflation pushes up costs, and a broad economic slowdown could really dampen demand in their key markets like consumer electronics and auto.
But you saved the biggest threat for last, didn't you?
I think so. The single greatest, most immediate threat is geopolitical. Specifically, the potential for new U.S. tariffs on Chinese imports, maybe starting in 2025. There's talk they could be as high as 100%. Now think about that. 60–70% of Navitas' revenue comes from China. A 100% tariff. It would be utterly devastating.
How could they even survive that?
That's the existential question. They'd basically have two bad choices. Absorb the tariffs, which would completely wipe out their already negative margins, or pass them on to customers, making their products totally uncompetitive in their biggest market. And that's not even counting potential retaliation from China, like restricting access to critical raw materials like gallium, which they need. This isn't just a risk, it's a potential company killer, depending on how it plays out.
Wow. Okay. We've covered a lot. Let's bring it all together in Chapter 7.
Yep.
Conclusion. Let's synthesize this. Key bullish points, key bearish points for our listeners.
Okay, the bull case. It really hinges on their superior GaN and SiCs technology. The enormous markets they're targeting, AI, EV, renewables, that's over $20 billion, combined potential TAM, the validation they've gotten from industry leaders, that fortress balance sheet giving them runway, and importantly, the new experienced leadership under Chris Alexandra, who seems to have the right playbook.
Okay, now the other side, the bear case.
Persistent unprofitability and that cash burn. The extreme geopolitical risk from potential China tariffs, that's the big one. The really concerning pattern of heavy insider selling. Significant execution risks around the manufacturing transition and the strategic pivot itself. And finally, a high valuation combined with clear market skepticism shown by that very high short interest.
So our DCF model tried to balance all that.
Right. Balancing aggressive growth hopes with those substantial risks, it gave us that estimated intrinsic value range, $4.50 to $7.50 per share.
And as of today, September 9th, 2025, Navitas is trading at $5.61, right smack in the middle of that range. So what's the takeaway for you, the listener?
It means an investment in Navitas today is, without a doubt, a high-risk, high-reward proposition. Full stop. It's fundamentally a bet on the ability of this new management team to pull off a very tricky strategic pivot into AI and EVs. And they have to do it successfully before their window of opportunity closes, or before those very real external threats, especially in the geopolitical ones, overwhelm their considerable strengths. It's a real balancing act on a high wire.
That is definitely a lot to weigh up. Here's something to think about. How quickly can a technology that seems kind of niche suddenly become absolutely essential for huge global megatrends like AI and electrification? And conversely, how fast can geopolitics just completely rewrite the rules for a company's market and its supply chain? Navitas' story, I think, tells us a lot about the true cost, the often hidden costs of complex global supply chains,
and relying heavily on specific regions for revenue. So if you found this deep dive valuable, we'd really appreciate it if you'd like and subscribe to the Stock Analytics AI YouTube channel. Remember, for just $4.99 a month, our members get priority deep dives on tickers. We're actually covering all of the S&P 500 stocks in the coming months, and members get exclusive priority access to those. And if you just want a one-off deep dive on a stock you're interested in, you can always drop us a super thanks.
And just a reminder, as always, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please, always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. We'll see you next time on The Deep Dive.